Diwali kab aayegi, I think, is the term which we have started using for earnings now. We're waiting, waiting, waiting. It never picks up.
Yes, again, because the earnings pickup ultimately is linked to the broader macro recovery. So once we see a big upcycle in the macro and GDP, we will see a big upcycle in earnings also. But beyond that, there obviously will be pockets like the commodities and global energy pocket, which saw earnings being strong for last couple of years. I'm guessing there will be a time over the next 2 years the banking sector will see good earnings because the worst of provisioning will be behind. So Y and Y numbers will look good. But the underlying numbers being solid growth for the broader markets, that has to come only when the economic recovery is stronger. And by economic recovery, I don't mean economic growth moving from 7.3% to 7.5%, but moving more closer to the 8% or higher. That's what we need for a more broad-based and higher earnings growth on a more sustainable basis, which is what the markets are hoping and pricing in for last few years.
Gautam, now what do you make of the current construct? FIs were rampant sellers in the month of October. Thankfully, the selling has reduced. Do you think they're done away with the excesses, or it's a matter of maybe, if not weeks, if not months, weeks, and selling will come back?
So firstly, if you look at the absolute quantum of selling by FIs, where the absolute dollar billion numbers look big, but in the context of what their holdings are in India, it was actually minuscule in the sense that it didn't really move their overweight positioning in India dramatically. They reduced their overweight position, but they still remained overweight. Over the last few days, what the buying, etc., we have seen, or respite from selling, is largely also what's happening the broader global emerging markets also. We are seeing some hope of a pickup in emerging markets after the correction, as well as around the noise bites around potential US-China trade deal, which will be positive for emerging markets surely. So this is what's helping the recent respite from selling or some buying, and also from an India perspective, correction in oil is also helping sentiment.
Gautam, have to talk about the marathon meeting yesterday, the RBI board meet, which lasted a good 9 hours. And, you know, key decisions on the economic capital framework, PCA, MSMEs have all now been pushed to a committee which is going to be taking and, you know, deciding on these key decisions. Would you say that the meeting was largely inconclusive and this is one of those kick the can down the road kind of approach?
So look, the entire debating point between RBI and the government over the last few days at the core, in our view, is a simple debate, which is the broader policy stance. RBI, through its various policy tools of rates, OMOs, intervention in FX markets, has been running a particular stance in terms of liquidity and the broader monetary policy stance. Government has clearly not been happy with that, both in terms of high real rates as well as the broader liquid environment, which showed up more starkly in the form of NBFCs. So that's the core, and all these elements which is being debated, the underlying debate is that, and obviously part of that underlying monetary policy stance is effectively a money supply argument, where the central bank is always has a particular range of money supply in mind, which in its view is what is supportive of the inflation targeting mechanism it has, given that that's the mandate it has, and government has its own considerations. That was the core. So in that context, what we saw yesterday, there are 2 points I would say. We haven't seen anything conclusive from yesterday's meeting which suggests that the liquidity stance or the monetary policy stance of RBI is going to change dramatically in a hurry. Secondly, the interesting point also is that while the investors have been concerned about RBI's independence, and from all this, even government has made sure that RBI's independence is kept intact. We also saw yesterday that, I think for a long time we haven't seen that, there was a press release after the RBI board meeting, and so it does bring into markets context that RBI board also has some role to play, which is a new development, and we have to see how that progresses over time. But the big for the market takeaway is, one, RBI's independence still intact. Secondly, there's not going to be any dramatic change in liquidity or monetary policy stance in a hurry. Over the medium term, once we see the capital regulatory framework or as the points you mentioned, who knows. But as of now, no dramatic change in liquidity stance.
Moving away from that, I just want to talk about how India has performed as opposed to the rest of the world. And if I just look at the November performance, Gautam, India has actually outperformed along with China. India has maintained that 3.6% return, China at 3.3 at a time when S&P 500 has actually gone down -0.7%, and we've seen a big shake-off happen overnight as well, what with the FANG stocks falling and the Dow taking a knock of about 400 points. Would you say, considering year-to-date we've fallen a lot more than the American markets, we stand a chance to fall a little less at a time when FANG stocks have just about begun to fall? Or do you think if FANG sell-off is going to get abbreviated from here, there will be no hiding space even for us?
It works both ways, and a tough one to answer, because US markets correcting also means, generally speaking, the risk appetite goes down, because that's where the bulk of the money comes from. So if the risk appetite comes down because a lot of the investors in US are losing money, that does not necessarily work well for other markets. On the other hand, clearly there is some asset allocation call, and as I was saying in the beginning, there is some hope building up for emerging markets specifically, that they have been beaten down, valuations are now attractive, and hopefully US-China trade war could create some opportunities. Once that there is some respite around that, see opportunities for emerging markets. So it works both ways, frankly, but if we see a sustained sell down in the US, then net it won't be positive for emerging markets in India.
Overweight on retail private banks and the technology space. Give us your outlook on technology. Now the rupee's reversed a bit. It's not like it's in a structurally strong trend, but even so, 8-week highs coming in. What would that mean for the IT trade?
So again, rupee plays a small role in the near term, both sides. So that obviously helps sentiment and some tactical portfolio calls for the sector. Even having said that, I don't think the markets were pricing, building in the numbers when rupee had gone to 73, 74. But obviously in the short term, it could act as a headwind if rupee remains strong or becomes stronger here on. But the bigger reason for us to be positive IT is that we are seeing clear signs that in the increasingly digital area of IT services, the Indian incumbents are gaining a strong foothold now. And the commentary from them, in fact, in our conference last week, most of the IT majors very interestingly had an upbeat commentary on the demand outlook. So there is a possibility that they beat estimates also over the next year or two. But yes, in the near term, currency could play a role.